Aloha, Inspired Moneymaker. Thanks for tuning in. If this is your first time with us, welcome. If you're returning, welcome back to Inspired Money. I'm your host, Andy Wong, aka Advisor Andy. A Klimt sold for $236 million. Basquiat have crossed 100 million, I think more than once. So if you read the headlines, investing in art can look effortless. But here's what the headlines often don't tell you. The collector who paid $6 million for a Monet, only to discover that it had been cut, heavily restored, and was suddenly worth a fraction of the price. Or fractional investors locked into shares that they didn't know that they couldn't liquidate immediately. The emerging art stars from 5 years ago that the market is having a harder time finding a bid today. In episode 98, just a couple weeks ago, we asked the question, is art actually a good investment or just something people want to believe is a good investment? Today, we want to go deeper. We're unpacking the real playbook behind art investing. Blue chip masters versus emerging breakouts, how to vet an art advisor before you wire 7 figures, when volatility signals a bubble and when it signals opportunity, and how AI and blockchain are finally bringing transparency to a market that's operated in the shadows for centuries. To do it, we've assembled 5 of the most connected minds in the art world. We're talking billions in transactions, decades inside the top auction houses, the founder of a platform democratizing art ownership, a leading scholar studying where art, commerce, and culture collide. This is episode 100 of Inspired Money, the Art Investor's Playbook. Before we jump in, I want to take a moment to thank our sponsor. Today's episode is brought to you by my financial advisory firm, Runnymede Capital Management. At Runnymede, we believe good investing starts with clarity. Before you chase returns, whether in stocks, alternatives, or even art, it's important to understand how everything fits together in your overall financial picture. That's why we offer a 3-minute financial plan, a simple, practical way to see where you stand and what you might want to focus on next. No jargon, no pressure, just a clear snapshot of your money and your priorities. If you want to get a quick gut check on your finances, visit inspiredmoney.fm/getplan. That's inspiredmoney.fm/getplan. Runnymede Capital Management. Plan well, invest wisely, and worry less. Now we've got a great panel. Let's bring in our guests. I welcome back Nanne Dekking, co-executive chairman of Winston Artery Group, and one of the leading innovators bringing data science, AI, and blockchain into the art market, a former vice chairman and worldwide head of private sales at Sotheby's and founder of Artery. He spent decades advancing transparency, provenance, and trust in high-value art transactions. Nanne, welcome back.
Thank you, Andy. Great to be back. Great panel, by the way.
Thank you. Thank you for being here. We're also welcoming back Philip Hoffman, founder and chairman of the Fine Art Group, a global leader in art investment, advisory, and finance. After rising rapidly through Christie's leadership, he launched the firm in 2001, now advising more than 350 family offices on over 20 billion in art annually. Philip, welcome back.
Lovely to be back. Thank you.
We also have Scott Lynn, founder and CEO of Masterworks, the platform pioneering fractional ownership in blue chip art, a serial entrepreneur and serious art collector in his own right. He's helped open access to an asset class historically reserved for the ultra wealthy. Scott, welcome.
Thanks, Andy.
Next, we have Natasha Degen. She is director of Sotheby's Institute of Art in New York City and a leading scholar of the global art market. Her work explores the intersection of art, commerce, and cultural value, and she's the author of multiple books examining how markets shape meaning. Natasha, so glad to have you here.
Great to be here. Thank you.
And rounding out our panel today, we have Scott Nussbaum. Scott Nussbaum is Deputy Chairman, Americas at Phillips, and a Senior International Specialist in Modern and Contemporary Art with more than 2 decades in the auction world. He's been behind some of the firm's most significant consignments and headline sales. Welcome, Scott.
Thanks very much, Andy. Pleasure to be here.
Yes, and I think I'll be calling on each of you. I'll be calling on Scott Nussbaum and Scott Lynn just for clarity, so that no one has to be called Scotty today. No one raised their hand for that one. With this much market experience on one stage, let's zoom into the starting point for every collector: blue chip versus emerging. Let's jump into segment one.
Today, art investors face a strategic choice: stability or speculation. Blue chip masters, Warhol, Picasso, Richter, are the market's fortress assets. Their value is underpinned by museum holdings, decades of critical acclaim, and a global collector base. In today's higher interest rate environment, with 10-year treasury yields above 4%, these works serve as capital preservation tools, offering liquidity and reliable long-term performance, even as equity markets continue to reach record highs. Emerging artists, by contrast, are the venture capital of the art world. The frothy days of wet paint flipping have cooled amid broader market normalization, creating opportunities for serious collectors to acquire promising talent at more reasonable prices, if they are willing to accept volatility and long holding periods. A balanced portfolio often combines both: blue chips as the stabilizing core, and a smaller allocation of emerging stars as high-risk, high-reward bets on the future of the market.
Philip, you advise some of the world's largest family offices. How do you guide them to balance blue chip preservation versus emerging growth?
I think I don't really guide them on emerging growth. I've tried that and done that in venture capital funds many years ago, and it didn't pay off. And so, if you're looking at an investment, I've always said stick to the blue chip end of the market, and the emerging artists are for enjoyment, for passion, not for investment. The risk is the same as a needle in a haystack. You could get 1,000 to 1 return, or you could lose the entire investment. And I've got plenty of examples of both. But in terms of advising our families on the blue chip, many of our clients, for many of our clients, it's about timing. It's about diversification. It's about expertise. It's very complicated to, as I outlined in the previous show, investing in art and buying blue chip art is not so simple. You outlined that Monet that didn't have the right discipline, and the guy lost 6 million on the deal because he didn't do his homework, didn't understand what he was doing. I think blue chip art is where I focus for our clients, and what I would term blue chip is what you see in the evening sales at Sotheby's, Christie's, Phillips, in the modern impressionist and contemporary markets, and typically around the million to 100 million plus. I mean, we underpinned probably a quarter of the sales in November, focusing on blue chip. We were the underbidder on the Klimt, just at about 200 million all in. And we bought a couple of the other Klimts for our clients. So we're very much into the blue chip end. And we very much avoid the emerging art, just because unless the client wants that as part of a collection, as long as he doesn't ask for an investment, then we're happy to give them advice and build their collections at that end.
Thank you for sharing that experience. Scott, Lynn, from your data at Masterworks, how do blue chip masters actually behave during broader market volatility compared to stocks?
Well, I mean, I agree with what Philip said about emerging artists. I think in terms of how do blue chip masters behave, I think one of the things that we all realize now is that there's a lot of beta in the art market. So usually what we see is that most artist markets tend to go up and go down in the same patterns, but the magnitude is different. So blue chip, we see the magnitude of changes more constrained, both on the upper end of that as well as the lower end of that, compared to emerging. So, I think when you're thinking about what to invest in, that question is very specific to someone who's looking for a financial return. And we think about that just as what is the risk adjusted return. So as an investment advisor, we're looking at the appreciation rate over the volatility, and blue chip has interesting risk-adjusted returns. So we would typically focus clients with conservative or moderate risk tolerances on that segment of the market.
Scott Nussbaum, on the auction floor, where are you seeing the strongest conviction today? Museum grade masters or next generation breakouts?
I think it's a combination of both. We've definitely had an adjustment over the past several years where some very young contemporary artists achieved really explosive growth in their markets. That has cooled off a bit. On the heels of that, we've seen more interest go into those more blue chip artists, some names that weren't so desirable before or weren't as, quote unquote, hot as before. People are returning to them. So, the markets are always in flux. When we do see a correction in one segment of the market, we usually see an appreciation in the other. And that's where we're in the midst of right now. I think you saw that in the fall sales. Also, a large part due to the quality of the material that was on the market. The works that Philip had referenced, that his clients had bid and bought, were some of the best works by those artists to come up in generations. One thing that I would say is kind of a hedge against no matter what is going on in the market is quality. And quality works of art by desirable artists will always seem to outperform.
Natasha, in your research, what can we learn about speculative periods versus risk-off periods?
Yeah, there does seem to be a kind of pendulum effect. And this moment, like Scott was just saying, there's maybe been a shift away from the ultra contemporary that saw explosive growth around the time of the pandemic and a flight towards more historical material. I'm reminded of another recent move away from the kind of emerging level to perhaps more historic material. If I think back to over a decade ago, there was a speculative bubble for a group of young emerging artists who were derisively called the zombie formalists, if anyone remembers that, who were known for their process-based abstract painting. And then that kind of explosion of interest took place around 2013, 2014. After the market for those artists cooled, we saw a resurgence of interest in more historical material by artists that had perhaps been historically overlooked. So I wrote an article for The New Yorker about a group of Korean artists whose style of painting is known as dansaekwa, which literally means monochromatic painting. They were all in their 80s at the time and kind of overnight became market darlings after decades and decades of being relatively unknown. So these were artists who had seen their prices at auction, their top prices had been under $15,000, and then overnight, seemingly, they were selling their works for several $100,000 or even millions of dollars. I think that at that moment there was a sense that there was a kind of healthy correction that happened. The speculative euphoria around these young artists gave way to a desire to find work with more historical depth and even gravitas, and perhaps we're seeing something analogous today.
What a cool example of an 80-year overnight success story. Nanne, can data now identify the inflection point where an emerging artist is becoming blue chip?
I think asking the question and started with data is the most important part, right? I mean, what kind of data are you talking about? I mean, my company is known for owning the largest data set of repeat sales of the public side of sales going back to the 80s. Every auction that took place of many, many artworks and collectibles we have recorded. That gives you many data points. On the other hand, what you should not forget, 50% of the trade is actually off market, is not off market, but is done on the private side of the market. The Winston Artery Group is not so much on the art market side. We're very much making sure that these very big collections that our clients own, we represent 30% of the largest collectors in the world, all over the world. And these collections have already very big collections that we've built up, not necessarily with our help. So getting a real sense of what they own, making sure that our experts can look at comparables to make sure that they can give the wealth advisors of these clients or the clients themselves a very good idea of what is the value of my art portfolio. For that, we do use data, but the data are not necessarily only public data. We also have a wealth of information about private data coming from all the art dealers in the world that always send us information. And our company does like $15 billion in appraisals a year. Needless to say, that's all private information. Nothing will be compromised, but it gives you many data points that you can then use to look at what would be the current value of this art collection. And needless to say, the next step could be, and as every other company, we use a lot of AI for that to create prediction models. But I always say you need to have real experts on board, and we have 50 people on board, and then a whole group of people we hire for specialties that we don't have in-house. When you represent a market that is formed by outliers, right? There's always an outlier that all of a sudden gets these very high value or all of a sudden tumbles down. You need real specialists to look at the information you get from data and the AI models that look at these data. But yes, we're only at the starting point to look very thoroughly at the data points that we have in an actually not that large market, right? It's only $65 to $70 billion of art that's being sold every year, but there's trillions of art in people's houses and in warehouses and all that. And those are also the data that we very much look at.
Thank you for that. I think in this first segment, we covered a lot. Makes sense to have a focus on quality, whether it is blue chip or emerging. And I'm sure having the right mix to match someone's appetite for risk so that you are indeed seeking risk-adjusted returns and enjoying the art that you purchase. Let's move on to segment 2.
The fine art market is opaque, unregulated, and relationship-driven, making it easy for new collectors to overpay or fall into traps. A professional art advisor can provide the insider's edge, access, diligence, and discipline. The best advisors open doors to coveted works by leveraging their relationships with top galleries and fairs. They conduct due diligence, verifying provenance, condition, and fair pricing, acting as a safeguard against costly mistakes. And they impose discipline, helping collectors define goals, avoid hype-driven purchases, and build a coherent collection. Before hiring, ask pointed questions. What is their specialization? How are they compensated? Do they disclose conflicts of interest? A credible advisor is transparent, passionate, and well-networked. By vetting carefully and aligning incentives, an advisor becomes more than a consultant. They are a long-term strategic partner in building both cultural and financial value.
Natasha, how has the rise of professional advisors reshaped the cultural, not just the financial side of collecting?
Yeah, I mean, I think the professional art advisor is a relatively new role. Of course, there have been figures advising collectors throughout history, whether they be, dealers or other collectors, other prominent tastemakers. But I think it's really in the 1980s that we started to see the art advisor as a, distinctive role within the art ecosystem. And since then, the numbers clearly have exploded to the point that people have talked about the kind of Gmail art advisor, right? Somebody who's just armed with an email account and is yet presenting themselves as an art advisor, trying to win clients. Some of your listeners may find it surprising that, if they go to a barber, that person has a license, and yet a professional art advisor need not be similarly certified or licensed. And so it's very important, I think, to vet, if you decide to work with an advisor, to vet that person And there are professional bodies like the Association of Professional Art Advisors that, have membership and vet those members. So if you do decide to work with an art advisor from that association, you can be guaranteed that they're conforming to best practices. And that's something that I think is quite important, especially at this time when, certain art advisors have been in the news, people like Yves Bouvier or Lisa Schiff, for not abiding by best practices. And so, I think it's very important. At the same time, when you think about cultural value, on the one hand, you see that art advisors are providing an essential function in the art ecosystem, acting as middlemen for people who are interested in art and maybe don't have the time or the background to confidently purchase art on their own. They're being guided and educated into art collecting by advisors. At the same time, though, some people have said that art advisors have resulted in maybe a homogenization of some collections, that, that collectors are being channeled towards certain artists, and that taste is becoming somewhat constrained by working with advisors. So I think there's lots of different perspectives on this, but certainly they're making the marketplace a more efficient place to do business.
Scott Nussbaum, during auctions, how do great advisors change the outcome of a sale for clients?
Well, experience and knowledge, knowing what to ask for, knowing the market. I think it's very important for particularly new clients to have a guide in the art world. And whether that's an official art advisor that you compensate, whether that's people within the auction houses that you trust. Every work that comes up for auction has a story. There's a story about the artwork itself, which is important, how historical it is, the artist, what was going on in the artist's life at any particular moment. And then there's things kind of outside of the work of art, which are very important in terms of the value of that work of art. That can be condition, that can be provenance, that can be market awareness in the sense that, has this piece been on the market? Has it been quietly shopped around? Is it fresh to the market? What are comparable sales? Nanne referred to one of the great advantages of artery is that they have all this information, this private information. Yes, half of the market is public in terms of auctions and auction results. Half of the market is private. How do you understand that private information? You have to have access to it. You have to have relationships. You have to know where to look. So for all of those reasons, I think it's very important to have people that you trust in the art market, people who have experience, people who are transparent, and that will always lead to better outcomes for you as a collector and as an investor.
Scott, Lynn, Masterworks operates at scale. How do you institutionalize diligence and discipline for smaller investors?
Well, all of our offerings are public offerings. So when you invest in a painting through Masterworks, there's an offering circular that's very similar to a public company. So you can read the risk disclosures, you can understand how comparable or similar paintings have appreciated over time. You can understand how we think about risk in that artist market. So we basically productize all of that data and then deliver it to each investor with each artwork so they can make an investing decision.
Philip, when hiring an advisor, what's the most important question that collectors might fail to ask?
I think one of the big issues on the art advisors, there are about 4,000 art advisors out there, but there are only probably 10 in the world that are any good. Who've got the experience worldwide to understand the market, who've been in the market a long time. In the Fine Art Group, I've got 100 staff with 40 experts who ran Christie's or Sotheby's, Patty Wong, who was chairman of Sotheby's, who's bought billions of dollars, if not tens of billions of dollars of art, and sold huge amounts. And that expertise and experience that the Fine Art Group brings is critical in understanding. And the Financial Times ranked us number 2, 3, and 4 of the world's top 10 art advisory groups because the headline for us was that we stop our clients buying 90% of the art they're offered because there is so much art and there is so much marketing going on and there's so much wrong incentives to buy or to sell. And we have the discipline to make sure that's not in place. And that's why probably of the world's top 20 banks and financial institutions. We've been hired by about 16 of them because they trust what we say and the integrity. And I've been involved in the art for 35 years. I've been regulated by the Jersey and the Luxembourg regulators. There's probably no other advisor in the world that's regulated in the same way and has been as actively and has got involved in as many trades as we have and found the mistakes. You only learn how to run the advisory business if you've learned the sort of 25 mistakes of buying art. And so many clients don't have advisors with that experience, and they usually screw it up.
Indeed, making mistakes is the quickest way to learn anything. Nanne, in addition to being known as an innovator, you're also a connoisseur, deeply rooted in the old masters and impressionists. Have you ever encountered an authenticity issue firsthand?
Good question, by the way. Let's first go back to the question, right? I do believe that an art advisor is a person who is capable of saying no. He should be put in the position that he can tell you, don't buy. For that, the art advisor needs to be independent. For that, you have to pay for an art advisor and make sure that the trader is not paying the art advisor. So that's, to my opinion, is the most important thing. And next to that, you're talking always with big egos, and there's passion involved, right? People really want something. That's the biggest differentiator of your investment portfolio. You're talking things about that you love and you really want to own, and then you're in the position to say, nope, you're not going to buy it for this and that reason. Talking about, yes, I've always been obsessed with art. That's why I'm doing this. That's why I also believe in the technology and the data that we're using, because I want to find confirmation that's not necessarily Nanne Dekking's opinion, but is also based on big data, etc. I think arrogance is the most complicated thing in our market, because you're talking about passion, you're talking about taste, etc. So I have actually myself sold a forgery. All the specialists in the field believed it was actually by that painter, painted by that painter. And the moment you see the forgery next to the original work, because we were allowed to get the original work back, and of course we dealt with it in the most discreet way, and we were all extremely embarrassed. But what I learned from that, because it was quite early on in my career, never take for granted that you know everything. And it's a very complicated market, because we can say the blue chip art stabilizes your art portfolio and can be a good investment. It's 90% of the time not a good investment. What kind of blue chip art are we talking about? And if it comes to old masters, if you don't understand that there are only 2 people in the world who can authenticate a piece as being by a certain artist, then you should not be in this business. And by the way, every generation has their own Leonardos. Every generation has their own Rembrandts. So it's a very, very complicated business where I have learned the Debbie Downer of the art market, I would say, is to often say no to people. But that's not our job, right? Our job is to look at huge collections, make sure that these people understand what they own, what is the risks in their collections, what can we do to help them to mitigate risks, etc. But yes, I can proudly say, because I learned a lot from it, I've sold forgery in my lifetime. And it was even an impressionist painting where I'm often considered to be a real specialist in.
Let's move on to segment 3. We're going to talk bubbles or bargains.
The modern art market offers both extraordinary upside and serious risks. Volatility is highest in the ultra-contemporary sector, where hype can push works to many times their estimates, often followed by sharp corrections. Illiquidity compounds the challenge. Unlike stocks, selling a painting may take months, and in a weak market, buyers disappear. A rising buy-in rate at auctions and frequent flipping are classic bubble signals. By contrast, rational pricing and longer holding periods suggest healthier conditions. For investors, the best defense is discipline. Treat art as a small share of your portfolio. Build relationships with auction houses and dealers well before you sell, and adopt a long-term horizon of 7 to 10 years. Ultimately, bargains are found not in speculative frenzy, but in high-quality works with enduring demand, where patience turns illiquidity from a liability into an advantage.
Scott, Lynn, how do you keep fractional investors disciplined during downturns?
Well, it's a good question. I mean, I think if you just take a step back and think about the market today, and is this a good time to invest? You know, we look at prior market cycles, and we think about you know, how extreme has the drawdown been, and what is the upside going forward. So if you look at the data, what you see broadly is the market today is down about 35% from the peak in 2021. That decline is actually more than 0809. It's also more than 2000. It's arguably not as much as the Japanese crisis in 1990. The thing that's really interesting about that is our research team constructs indices in the market, and for the first time, really the second half of last year, we've seen prices bottom out. So I think when you just take a step back and you think about from 30,000 feet, what are good asset classes to invest in today? You have public equities that are at all-time high valuations. You have Bitcoin that's declined meaningfully, and some would say is in a bear cycle. You have contemporary art, which has historically outperformed public equities over long multi-decade periods, but is in a stabilizing moment that's down from the peak. We think that's really interesting. When you look at the average return for the decade after the dot-com bubble bursting, I believe it was 25% a year for 10 years. If you look at the average return after 0809, I believe it was 11% a year for 10 years. So I think we could be in a period right now that is similar to that. So when we talk to clients about allocating to art, we try to put it in that context. Like, we think at this point there's limited downside risk, and there's substantial upside.
Interesting. Yeah, very interesting to see if that's happening in art. We recently had an episode where we talked to LiveX about wine, and it sounds like that correlates to what the wine market is seeing, some stabilization and an upturn in pricing, or a bottoming process, sort of end of last year going into 2026. Scott Nussbaum, what are the earliest signs you see that a sector is overheating?
You know, that's a really good question. I find myself, when somebody asks me about a work of art, and I can't really tell them about the work of art, but what I can tell them is about who else is buying, or what gallery is rumored to be picking them up. When the descriptors that I'm using actually have nothing to do with the picture you're looking at, and everything to do with the noise around it, that's always kind of a sign to me that people are buying for the wrong reasons, or interested in the wrong reasons. So I always catch myself when I find myself doing that, and encouraging clients just to proceed with caution. Now, everyone collects for different reasons. Some people love that thrill. Some people love that kind of, or have so much, you know, FOMO about missing out on something hot that they don't care. And it's not my position to kind of dissuade them from that. But if you're looking at it in terms of, as you mentioned before, like, what would this look like 7 years, 10 years from now? That's really a red flag for me, is when I can't say anything about the work of art.
Natasha, does illiquidity of art actually preserve art's cultural value by discouraging short-termism?
That's a very interesting question. I mean, I think that especially when you look at the work of living artists, there's always been this speculative quality, both financially and aesthetically. So going back to the early 20th century, when we saw the very first art funds start, and a group of investors speculating on works by Matisse and Picasso, held on to those works for 10 years, then sold those off and made, at the time, quite impressive returns. They were speculating both financially, it was an investment, but also on art that was quite radical and new and felt extremely fresh, even daring to collect. You know, and yet we see now the market today, contemporary art is by far the most important sector. It's the largest category in terms of market share. That's kind of become the market in some public sense anyway. And yet there is an inherent kind of volatility to contemporary art because we do not know who the Rembrandts of our generation are going to be. And I don't know that people are always thinking with kind of art historian eyes, really trying to think about what is going to withstand the test of time. I think absolutely what Scott was saying, people are often collecting with their ears and not their eyes, and are kind of overwhelmed by the discourse around the work rather than the work itself. So in a sense, art it's a liquidity, should preserve cultural value, as you're saying. But I think as contemporary art has become more and more important, it's harder to really have that historical advantage, even if it remains, an illiquid or relatively illiquid asset.
Philip, you expressed a preference for blue chip. Are you finding bargains anywhere today where others perhaps may be overlooking?
Look, I often think we've been in the art fund industry for 25 years as the first guy to build a mutual art fund out of Delaware back in 2001. And I've seen the pitfalls, and I managed to exit. I think we're the only guys in the market who've exited all the art funds and shown the successes and the failures. I think the critical issue, blue chip art is where to focus, but having the expertise and knowing how to buy and how not to buy. I emphasize to clients that when you're buying art for investment, you've got to know when the low is, and right now there's a low. And if you bought 4 years ago, you were at the high and you'd be down 30 or 40% potentially. And one of the other issues is, of course, sorry to say it, but the auction house fees are about 40% spread. They just raised their fees again. And the dealer spread can be big. So if you're buying for an investment, buying cleverly makes a huge difference. If you're putting $100 million into art and you've got a 40% spread and you're down to 60 million because of the spreads of costs, and then you've got other costs of holding it, you've got to be that's the difference from the public equity markets where the spread is 0.1%. So I warn against people thinking that it's an easy investment. Yes, we've made money investing in art over a 10-year period in our different investment funds, but be warned about the cost of doing so, and be warned about the challenges. So I never bought any art at auction. I sold heavily at auction. I bought a lot of art for our funds privately, direct from the owners, because we have the data and access to a lot of the owners around the world across our team at the Fine Art Group. And you've got to be able to have the scale to negotiate wholesale fees when you're selling. And so it's not an easy investment. And the amount of capital I'd ever recommend deploying into a sort of investment in art right now is, for anybody, would be, I wouldn't want to max out at much more than a couple $100 million, because beyond that, you're buying too much of the market. The market's too small. There are not enough investment opportunities, and the opportunity for that 30% discount, distressed opportunity is really one in 1,000. So it's really tough. We fish through billions of dollars of art to find that opportunity.
Nanne, can AI help to detect bubble behavior, or when we're in a bottom? Can it help us to identify where we are in the cycle?
It can identify risks in the collection that we manage for our clients, for sure. Definitely, if you have scholars and people who really know art looking at the data, but definitely if you have a $200 million or $300 million collection, and we have other data points, and very likely most data points in any other company currently in the world, yes, you can see trends, you can see risks. I'm very risk averse, so I would always be listening if someone tells me there's a risky part of your art portfolio, and see what you can do with it now rather than to write it all out. Having said that, we have quite a few clients for whom we manage accounts, meaning that they already have a very distinct portfolio of, let's say, old masters, and they're looking for exposure in another part of the market, for example, emerging artists. But that's a very calculated risk these people are taking, and we warn them, right? We can tell them, emerging artists, go for it, but let's make sure that we only buy emerging artists of whom we already know that some very well-known collectors are buying it, etc., etc. But yes, predicting risk is definitely something where AI can help you, as it does in every other market. So my answer would be yes.
Well, I guess in art, like everything else, timing can be everything. Let's move on to segment 4.
For centuries, art investing has struggled with opaque pricing, authenticity concerns, and illiquidity. Technology is now addressing these weaknesses. AI valuation platforms analyze millions of auction records, exhibition histories, and even media sentiment to generate objective, data-driven estimates of value, replacing guesswork with pattern recognition. Blockchain provides the missing link of trust, a tamper-proof record of provenance and ownership that can follow a work for its entire life. NFTs and smart contracts extend this further, offering digital certificates of ownership and ensuring artists receive royalties on future resales. Together, AI and blockchain bring transparency and structure to a market long defined by opacity and insider access. The result is a shift from subjective, relationship-driven transactions toward a more verifiable and efficient art market, one that broadens access while still preserving the unique character of art as an alternative asset.
Scott Nussbaum, how is AI influencing estimates and pricing strategy at Phillips?
I would say, and to be totally honest, it really isn't. I think at this stage, the technology isn't there to really fundamentally alter how we do things in terms of pricing. I think we still very fundamentally believe that to determine what an accurate estimate on a work of art is, you need a consensus of real opinions. Each one of us experts brings a certain degree of knowledge to the table, certain relationships, certain buckets of information, and that all we aggregate all of that to determine what we feel is the right estimate. In the future, I do see ways in which AI can assist. Using something to kind of search the internet to see if a work of art that you're evaluating has appeared anywhere else on the planet, in an art fair, in a gallery, something like that. But one of the things that I think is still fundamental to our business is that experience, that firsthand knowledge, that firsthand experience that is very challenging, at least until now, to replicate by AI or digitally.
Philip, are your ultra high net worth clients, are they embracing tokenization or are they still skeptical?
They're not embracing tokenization at all. Then they're interested in AI just to do a quick search and get some quick data. But at the end of the day, they pick up the phone to our art experts and want our first-hand information. And the benefit of having such a huge team in all parts of the globe is that we can feel out the markets, we can feel out what's going on in the museums, and we can give them an in-depth view of what all our other clients are looking at and how the auction houses are thinking. We're very much up in the sky looking down at the whole market. We've got the benefit of having a very, very broad team with deep expertise and knowledge. And we give that, and AI and looking up on the computer gives you only a very small proportion of the information you need before you buy a work of art. And tokenization is not on any of our clients' agenda at all.
Natasha, does digitization risk commoditizing something that's inherently emotional?
Well, I think with tokenization, we are seeing the next sort of phase in art as an asset, and you could say that is commodification, new stage of commodification for sure. And yet, I think the art market relative to other markets that have already been thoroughly transformed by new technologies, the art market remains somewhat resilient. Actually, it's a market that is built on relationships. It's opaque, it's inefficient in many ways. And so, maybe we will see profound disruption and change, but as of now, it's making maybe the market marginally more efficient and transparent, but we haven't seen, a complete kind of reconfiguration of the way the market operates.
Nanne, how close do you think we are to a fully transparent, blockchain verified art market?
The infrastructure innovation is just beginning, right? And I don't think it's about making everything visible. It's about making what I always call the latest source of truth captured and secure. Tokenization is the most secure way to store information that you don't want anyone else to see, or only when you give permission you can share it. We have a lot of naysayers, of course, also in our client base, but I have to say, after what happened in Los Angeles, and people were absolutely convinced that these standalone servers that they had were the safest way to keep information, learn you or teach you, guys, come on, there's new technology and we should use it. Where I see the biggest change is most of our clients are wealth advisors or financial institutions together with the clients who collect art. And that's where the innovation comes from. They are very much guiding us and helping us to see how can we communicate with our client, what does tokenization do? There's so much smoke and mirrors about tokenization that it is all about fractionalization or visibility of information. There is no transparent marketplace, definitely not in the art market. And for many reasons, it should never become a completely transparent marketplace. I see it very much as an internal tool. I don't want to bother our clients too much with tokenization. It's under the hood. But I also want to make sure that if I have to, I can really, really explain to my clients, we're not compromising your identity, your privacy. We're actually doing everything we can to keep the information really private, but also secure the latest source of truth about that artwork and everyone who signed off on that information. And I think that's the biggest infrastructure innovation that will come. It will not necessarily come from the marketplace, although I do believe you have to work with the marketplace. That's why I have my collaborations with Phillips, with Sotheby's and Christie's. And Scott and I used to work at Sotheby's together. I know that the most transparent marketplace is ultimately an auction house. And the amount of art you see when you work at an auction house, for me having been a private dealer and working at the Wildenstein Gallery for many years, is stunning. And the more art you see, and Philip said it already, the more art you see, the more you realize the pitfalls, the research you should do, that you cannot be arrogant, that you cannot be cocky about your knowledge. Everyone shares the same knowledge these days because of Google, not even any other technology. An old master specialist who knew everything about a local artist in Rimini, I know exactly the same thing about the local artist in Rimini when I just Google the name. So yeah, there's a lot of inside knowledge that you need to have, real knowledge of the marketplace, but then let's have technology help us capturing all that knowledge that's out there to benefit the clients that we have, the passionate art collectors, but that's ultimately the people we do it for. As I said in the beginning, I'm very passionate about art, and that's what keeps me going every day.
Scott, Lynn, how does AI inform your acquisition strategy at Masterworks?
I mean, it informs it a lot. I mean, I would say that, our investment process very broadly is twofold. The first thing is we decide which artist market to go into. The second is that we select the best object at the best price in that market. So with respect to selecting artist markets, we use a lot of machine learning models and more AI at this point to help inform those decisions. And from an investing perspective, that's absolutely critical. Like Scott and I just did a webinar on the Basquiat market recently, and I think one of the things that's interesting about that market is it does continue to be a standout market compared to other artist markets that we follow. So even a B minus Basquiat at this point still performs quite well compared to the rest of the art market. So choosing the right artist is really critical to generating a return. It's probably a prerequisite.
Curious, have data models ever contradicted your personal collector instinct?
Yes. I mean, I personally collect mid-century abstract expressionism, which I just like intellectually, but is probably not the best risk-adjusted return in the art market today. So I think as collectors, sometimes personal preferences deviate from purely investment decisions. There's a lot of artists that are high appreciating artists that I don't necessarily want to hang in my living room. So preference can contradict investment, I guess.
Anybody else want to chime in? We are going to bring it home and go to the last segment.
Art collecting is no longer measured solely by financial return. A growing movement emphasizes a double bottom line: financial value and cultural impact. Ethical collecting begins with transparency, clean provenance, and responsible stewardship. Impact art investing takes this further, using capital to support underrepresented voices, preserve cultural heritage, and amplify artists addressing urgent social issues. In practice, this might mean allocating part of your budget to female or non-Western artists, supporting benefit auctions, or funding a project directly through patronage. Collectors also strengthen impact by lending works to museums, ensuring public visibility and institutional validation. From a financial perspective, this strategy aligns with powerful market trends. Museums and collectors are actively correcting historical imbalances. The result is a portfolio that not only grows in value, but also shapes the cultural narrative of the future.
Natasha, how is impact collecting changing which artists and stories get recognized and remembered?
Yeah, I think what you said in the introduction to this section, I mean, is absolutely true, that there's a real effort being made to correct historical wrongs, to elevate underrepresented artists. And of course, that's also about value. It's about recognizing artists that maybe have been undervalued by the market. Female artists historically have even the kind of most canonical names, the most recognizable names in art history have performed much at a much lower price level than their male counterparts. So that's something that is, I think, both about a kind of social agenda, but also a financial one. And that's a maybe rare instance where the two kind of dovetail. But also, I think it connects to a generational shift that's taking place more broadly among art collectors and patrons, people that are looking to have social impact with their acquisitions. You see how this is affecting even museums, where there's less of an emphasis on traditional ownership. Patrons who are instead making donations across institutions that are shared among institutions, are much more interested in supporting programming than objects themselves. So, I think that this is something that, especially as we see a generational shift of wealth, that we will be seeing more and more of.
Philip, how often are you seeing family offices requesting impact mandates within their art portfolios?
A huge number of our clients are very interested in this. This is, unlike tokenization, this is high on their agenda for discussion. We have a philanthropy division. We focus on donor advice funds, where our clients gift art into a donor advice fund, and then use the funds for the philanthropy to help museums build collections. A lot of our clients gift their art to museums, lend them out free of charge to museums. We've done loans in all over the world. We've got loans for our clients worth billions of dollars sitting in museums right now, and we orchestrate that and make sure it works for the museums. It works for and the philanthropy angle is very important. The impact investing is really important, and looking at artists that are from different ethnic origins, different areas, they're very supportive. So millions of dollars of our clients' money is going in exactly that area.
Nanne, I believe that this topic is near and dear to your heart. What are your thoughts?
Well, all of the above, what Philip just mentioned, right? With our trust and estate department, we help and guide our clients. But I would like to mention two formidable women in the art market or in the art world, Agnes Gunt and Alice Walton. If you look at Alice Walton with Crystal Bridges, building up that incredible collection and give it on loan very often to under-deserved museums all over the country. And that goes hand in hand with a $50 million grant that everyone living in those areas can actually go to these museums for free. I mean, that has real impact. And I'm not even talking about also the daring decisions made by her and her advisors to what kind of collecting categories they're going after. Also very much from, let's say, under-deserved creators. Agnes Gunt with her Art for Justice Fund, selling, for example, the Roy Lichtenstein. There are other examples where God knows how many tens of millions of dollars went to criminal justice reform. So we see a lot of big collectors using their collections in very, to my idea, admirable ways to make a real difference.
Scott, Lynn, is fractional ownership itself a form of impact by broadening access to wealth creation?
I mean, I think today, as we mentioned, Masterworks is primarily focused on quote unquote blue chip artists. So we haven't really broadened the platform to more emerging artists. We hope to do that at some point, and I think at that point it will have more of an impact on younger living artists. But today we've really focused on those blue chip names.
And Scott Nussbaum, are collectors increasingly prioritizing diverse artists in major consignments?
Oh yeah, definitely. I mean, and look, I think this speaks to something that is really the X factor about art and art collecting, and that's the joy of the process, and that's different for everyone. And so, some people might feel that joy when they learn about a new artist, a new genre, that joy of discovery, or even that joy of when you become a collector, when you appreciate art, you become a part of such an enormous global community. Anywhere in the world, doors are open for you if you appreciate art, if you collect art, and that's something that I think is just makes our market so exciting. And you can't reduce it down to a traditional investment because of that kind of joy variable. And what's interesting is also to see the way that the collectibles and art markets have evolved over time. So, obviously the topic of our discussion today is focusing on fine art. But look what happened just, I think, last week. A Pokemon card sold for $16 million. Comic books are eclipsing $10 million. Baseball cards, collectibles, entertainment memorabilia. It's all the different ways that people, find joy in that process of collecting. And so from an investment perspective, it opens up all sorts of doors as people find different ways to pursue their collecting passion. So yeah, I mean, the long and short of it is, yes, that's a big part of what brings people through the front door, is that idea that they're going to walk into Phillips and they're going to see something, whether it's a young contemporary artist from Ghana, whether like last season we had a dinosaur, a juvenile triceratops, whatever it is that brings that joy, that brings that desire of ownership, we welcome, and it happens every season.
I think we're going to leave it there on this message of joy. And I love this segment because it's really people using art for good. So I think that as we wrap up this conversation, one of my biggest takeaways from today is this. Art investing is not about chasing headlines. It's about building conviction. Whether we're talking about blue chip masters, emerging breakouts, advisor diligence, or even the role of AI and blockchain, the common thread was discipline. The collectors who win in this market are not the ones reacting to hype. They're the ones doing the homework, building relationships, and thinking in decades, not quarters. So here's one thing I'd encourage you to do this week. Pick one artist, established or emerging, and go deep on your research. Look at their auction history, study their exhibition record, see which museums hold their work. Follow the galleries that represent them. In other words, start training your eye and your investor instinct at the same time, because the real edge in art investing is not just access, it's also insight. If you enjoyed this episode, be sure to subscribe, share it with a fellow collector or investor, and stay tuned because we'll continue bringing you people and ideas shaping the future of money markets and alternative assets. Let's connect on LinkedIn. Find me by searching Advisor Andy. Inspired Money is I can't even speak. Inspired Money is powered by me, with Bradley John Eaglefeather running the live streams and handling the edits behind the scenes. Chad Lawrence adds the finishing touches with graphics, animations, and extra editing that help to make the show pop. I want to thank our incredible panel today, Nanne Dekking, Philip Hoffman, Scott Lynn, Natasha Degen, and Scott Nussbaum for sharing their insight, experience, and candor. We learned a lot about how the art market really works. To learn more about Nanne Dekking and the work he's doing around transparency and blockchain infrastructure, visit Winston Artery Group at wag-art.com. You can follow Philip Hoffman at his global advisory firm, the Fine Art Group, at fineartgroup.com. To explore fractional investing in blue chip art, check out Scott Lynn and his platform Masterworks at masterworks.com. And for deeper scholarship on the art market, visit Natasha Degen at sotheby'sinstitute.com. And be sure to read her books, including Merchants of Style, Art and Fashion After Warhol, and The Market. And to follow the auction market from the front lines, learn more from Scott Nussbaum and the team at Phillips at phillips.com. If you found this conversation valuable, please share it once again. And any guests, do you want to plug anything?
Just enjoy the journey.
Yeah.
Enjoy the journey.
And I love the group. It's so good to hear everything from different angles. Yeah.
Really appreciate all the perspectives. This has been episode 100 of Inspired Money. Thank you, everyone. Thank you to our guests. Thank you, Inspired Moneymaker, for joining us. Until next time, do something that scares you, because that's where the magic happens. Thanks, everybody.